This is the short note for foreign exchange rate regime and convertibility. Up to March 1993, India followed fixed exchange rate regime, where the value of Indian rupee was fixed by RBI against major currencies. From March 1993 onward, India shifted to a market-determined managed floating exchange rate regime, where exchange rate is mainly decided by market demand and supply, while RBI intervenes only to reduce the excessive volatility. Under the fixed exchange rate regime, changes made by the government or central bank is called devaluation, reducing the value of domestic currency, and revaluation, increasing the value of domestic currency. Under the floating exchange rate regime, the changes made due to market forces are called depreciation, fall in currency, and appreciation, rise in currency. India follows a managed float, which is also called dirty float, because excessive fluctuation in the exchange rate can create economic instability. The Reserve Bank of India buys and sells foreign currency, usually US dollar, to stabilize the value of Indian rupee whenever required. Nominal effective exchange rate (NER) is a weighted average of Indian rupees exchange rate against the currencies of India's major trading partner. Real effective exchange rate (REIT) is the nominal effective exchange rate adjusted for inflation between India and its trading partner. REIT is a better indicator for India's international trade competitiveness. Interpretation of real effective exchange rate. If REIT index is greater than 100, India Indian rupee is overvalued, making export relatively expensive and import cheaper. If REIT value is smaller than 100, Indian rupee is undervalued, making export more competitive and import relatively expensive. Coming to currency convertibility, which means freedom to convert Indian rupee into foreign currency and vice versa, which is of two type: current account convertibility and capital account convertibility. Current account convertibility refers to convertibility for transactions such as export, import, education, medical, tourism, remittances, and other current account transactions. India has full or near full current account convertibility, subject to certain restriction under Foreign Exchange Management Act FEMA 1999. Capital account convertibility refers to convertibility for transaction involving investment, purchase of foreign asset, borrowing, lending, foreign direct investment, foreign portfolio investment, and external commercial borrowing. India has partial capital account convertibility because unrestricted capital flow can create financial stability. Foreign Exchange Management Act (FEMA) in 1999 regulates foreign exchange trade in India. Certain certain transactions require approval or are subject to a limit to protect foreign exchange reserve and macroeconomic stability. Under the liberalized remittance scheme (LRS) introduced by RBI in 2004, resident individuals are allowed to remit up to prescribed annual limit, currently USD 250K per financial year, subjected to the prevailing RBI regulation for permitted current and capital account transaction. A country running a current account deficit (CAD) must finance it through net inflows in the capital account, such as FDI, FII, FPI, ECB, and other capital inflows. The 1997 Asian financial crisis demonstrated the risk of unrestricted capital account convertibility. Countries such as Thailand, Indonesia, Malaysia, and South Korea experienced massive capital outflows, currency depreciation, depletion of foreign exchange reserve, and balance of payment crisis. In contrast, India and China were relatively insulated because they maintained partial capital account convertibility and stronger control over capital flows. The SS Tarapur Committee in 1997, chaired by SS Tarapur, Deputy Governor of RBI, recommended full capital account convertibility in phases subject to important macroeconomic precondition. The first condition is fiscal deficit should be around 3.5% of the GDP. Inflation should be maintained between 3 to 5% for a sustained period. Market determined interest rate, which is decontrolled interest rate. Foreign exchange reserve ratio. Foreign exchange reserves should be sufficient to finance at least 6 months of import. Gross NPA of the bank should be below 5%. Cash reserve ratio should be around 3%. India did not satisfy all these conditions, particularly regarding the fiscal deficit, inflation, banking sector, health, and cash reserve ratio. Therefore, India continues to follow partial capital account convertibility instead of full capital account convertibility. In conclusion, India's foreign exchange policy has evolved from fixed exchange rate regime to a managed floating exchange rate regime while maintaining the full current account convertibility and partial capital account convertibility to balance economic growth, financial stability, and protection against external shock.